Good afternoon from Cape Town, South Africa, and welcome to our second in a series of Meet the Manager webinars, where we showcase some of the world's leading asset managers that are included in our portfolios. My name is Anthony Palmer, and I'm Group Commercial Director for Carrick. My fellow hosts are Louis Levy and Rob Enslin, who are the founders of Strategic Capital, a discretionary fund manager which run both local and international investment solutions for Carrick. Today, we are joined by Amit Goel from Fidelity International, who are one of the world's largest and most respected asset managers. Amit is speaking to us from Singapore and is co-portfolio manager of the Emerging Markets Fund and is also responsible for managing the India Focus Fund. The Carrick Investment Committee believe that in the current environment, emerging market exposure should be an essential building block in any portfolio. And all of our solutions currently reflect this view, with exposure of around about 10% to Fidelity's fund. I must say it was also very nice to see that the MSCI Emerging Markets Index was up 9% in US dollars for the month of July and is up 6% in US dollars over the last 12 months. With that in mind, I would like to hand over to Amit to hear his views on what has been happening in emerging markets, where the opportunities lie, and how the fund is positioned to take advantage of those opportunities. Amit is going to speak for approximately 30 minutes, after which we're going to open up for some questions from the panel as well as the audience. So please submit your questions during the course of the webinar. Thank you, Amit.
Yeah, thanks, Anthony. Hi, everyone. Good evening, and hope everyone is safe and sound. My name is Amit Goel, and I am a co-portfolio manager at Fidelity's Emerging Market Funds. And I also, as Anthony mentioned, I also manage the India Focus Funds for Fidelity. I will very briefly talk about myself and my journey at Fidelity and our investment philosophy and process. And then I'll take you through my presentation on emerging markets, which talks about why we think emerging market makes sense for investors. So I joined Fidelity roughly 15 years back. I joined as an analyst in India. I spent 7 years in India before moving to Singapore in the emerging market team. Within India, I cover a whole range of sectors from consumer staples to IT services. And I've been managing the Asia part of our emerging market portfolio since last 7-8 years. And late last year, I was appointed the co-portfolio manager of the franchise. I've spent a lot of time traveling across India in my first 7-8 years, but I have spent a lot of time traveling across China and parts of North Asia, Korea, Taiwan, Southeast Asia and Indonesia, Thailand. So there has been a lot of experience gained into the team in last 7-8 years in emerging markets, which I will try to showcase and my experience through a few slides from here on. Before I take you through my slides and talk about the key themes which are part of my fund, I will just take you through how we think about emerging markets and our investment process and philosophy. What essentially we are looking at in our fund is to buy the best businesses across emerging markets, whether it's Asia, EMEA or LATAM. When we talk about great businesses, we are essentially talk about market leaders which are present in growth segments, gain market share through their competitive advantages, and we see them growing over the next 5, 10, 15, 20 years. And we firmly believe that these are the kind of businesses, and a portfolio of these businesses can only add alpha in markets like emerging markets. So let me start talking about the current environment. Obviously, there's a lot of uncertainties driven by the virus and pandemic. I'm not talking about numbers here. Everybody knows about the infection rates and how these numbers stack up against every countries. But I think what I would say here is that there are a couple of things which we are focused as managers, which drives our thought process and strategy during this pandemic. Very first thing, I think China has given us a clear path to look at how we think about economic recovery, the pandemic progression, how consumer reacts to pandemic, and how economies can come out of this pandemic. The chart on the left-hand side, you would see China was first into the pandemic. The virus started in China, and China was first out of the pandemic. We have clearly seen economic recovery in China with PMIs recovering back to now pre-COVID levels. You talk about property sales, you talk about retail sales, you talk about auto sales. Most of these indicators are back to pre-COVID levels in China. While the economy is still shut in some parts like Beijing, but we have clearly seen that if you can control the pandemic, you can clearly come out of it. And I think that's a very clear path which China has shown to us. On the right hand side, you can clearly see some of the indicators like excavator, which is a very late cycle indicator, have sharply came back in terms of demand and growth, which clearly shows that if any country can manage pandemic very well, the economic recovery can be very sharp. But not every EM is similar when we talk about coping with this pandemic. And there are two factors which decide the economic recovery in each EM that we look at. Clearly, the first thing which I already talked about is the capability to control the pandemic. China, given the tight control of government in that country, they can have complete lockdowns, they can close the cities, and they have shown that in last 4-5 months. Obviously, that capability is less in other emerging markets like India, South Africa, Brazil, for etc. But the second most important aspect which drives economic recovery and stability of any economy in emerging market is the financial capability of any government. And when we talk about financial capability, it is about how much fiscal stimulus or money the government has, which it can kind of throw at the economy, whether you talk about consumer subsidies, whether you talk about infrastructure investments to stimulate the economy. And you would see it's at varying degrees given the financial capabilities of any country. China obviously has low debt to GDP, the government debt to GDP, and thus the government has more capability to stimulate, which we have already seen in China. But countries like Brazil, India, South Africa, where government debt to GDP is already high, given the low GDP status, as well as they are already running 6, 7, 8% of fiscal deficit as a percentage of GDP, we believe that the government capability to stimulate the economy through fiscal stimulus is very less. I think this is the key difference between developed market and emerging markets. US, you have clearly seen government coming out with fiscal stimulus, which is more than 10% of GDP. But in emerging markets like India, South Africa, Brazil, we would expect this fiscal stimulus to be low and measured. Thus, the ability to control the pandemic as well as gradual opening up becomes more important. The good thing I would say here is that while we have seen increasing numbers outside China, in India, Brazil, South Africa, the mortality rate remains very low, which means that the government can still balance the opening up of economy as well as the pandemic progression. We have clearly seen that. But that also means that the recovery in some of these markets will be only gradual. These economies will open up, the virus number can go up, you will clearly see the lockdown coming back again. So it will be always on and off till we see a vaccine, which we believe is another 6 to 12 months down the line. So in terms of our geographic focus, we clearly have a clear kind of interest in China, which I will explain through further slides. And we like China as a country, we find good stocks there to invest. And we are cautiously optimistic in places like India, and outside Asia, we are a bit cautious on Latin America as a region. Before I talk about various themes in emerging market, I think it is very important to discuss upfront why we like emerging market investing. And as Anthony mentioned that they expect everyone to have 10% exposure to emerging market, I think this slide clearly explains why. There's a big debate that last 10 years, emerging markets has clearly lagged developed markets. If you see SPX, the last 10-year returns are now in double digits, while emerging markets returns over last 10 years is only low single digit. I think a lot of it has to be driven by how the index was constituted in emerging markets. So the chart on your left hand side shows how the index has changed in last 20 years, the emerging market index. You would clearly see 10 years back in December 09, post GFC, the index was largely constituted by sectors like energy, materials, utilities, which were trading at high multiple and high earnings. And these sectors have clearly not performed. And they have been a very big drag on the emerging market index in last 10 years. On the other hand, good sectors like consumer, technology were small part of the index. While they have done very well, I mean, they have all the technology stocks in Asia have done as well as some of the FANG stock like Facebook, Amazon, Apple has done in US, but they were smaller part of the market, and hence, while they have added to the index, they have not been able to compensate the drag of some of the sectors which I talked about. And clearly now the composition of the index has changed. The emerging market index has become very much driven by technology and consumption. If you see information technology as a percentage of index has come up, but also within communication service, the large part is Tencent. So if you add information technology and communication service and consumer discretionary, which includes e-commerce, this is almost half of the index. And some of these companies, large companies like Alibaba, Tencent, TSMC, Samsung Electronics, we believe are the best technology companies and the best consumer companies to own for next 10 years. They are large part of the index and they will drive very good performance on EM. Second thing, we believe that the EM growth, which was anyways higher than the DM growth in last 10 years, will continue to be so. Roughly 60% of EMs is now driven by countries like China, India, Indonesia, which are still growing at anywhere between 4 to 7%. So we believe that emerging market in terms of real growth will still remain 4-5% versus a 2 to 3% developed market growth. So you still get a better growth, now better constitution of index. And third, most importantly point is valuation. We think the starting point on emerging markets is very cheap. The valuation discount to developed market is at historical high. We are already talking about 40 to 50% discount to developed market. And hence, it's a very strong backdrop to invest in emerging markets from here. Let me talk about a few themes and few stocks which will illustrate how we think about emerging markets in general. First thing, I talked about technology and consumer being large part of emerging markets. We clearly like them as sectors, but we are also at this point of time interested in industrial sectors, especially in China. As I talked about, that China has the capability to stimulate the economy. They're already doing that. Fixed asset and infrastructure is half of Chinese economy. Actually, you have to be there in China to see that how big is the infrastructure investment in that country. I mean, I have traveled to almost 25 cities in China in the last 5 years. I've spent more than 100 days in China, traveling from every nook and corner. I think the kind of infrastructure you see in China and outside China, people who have not been to China, they talk about ghost cities, they talk about empty roads. It's not the case in China. I mean, they have created world-class infrastructure, which has added to a lot of growth to the economy. And I think they have the capability to reinvest in that infrastructure. I mean, I'll give you an example. When I go to China, the key cities are Beijing and Shanghai. They're roughly 1,500 kilometers apart. I think the same distance as Cape Town to Joburg. And we used to fly from Beijing to Shanghai most of the times. It would take us an hour to go to the airport, couple of hours of flight, waiting time at the airport. And now China has created such a great high-speed rail network. I can take a train at the city center in Beijing or Shanghai. It takes me 5 hours in train from the city center in Beijing to Shanghai or vice versa. I mean, this is so much productivity added to the economy through this fixed asset investment. And we think China at this point of time has the capability to further accelerate infrastructure investment. And that's why we like very selective industrials in China. It's an example here. We are talking about this company called Seni Heavy. It is the largest excavator company in China with 25% market share. And you can clearly see how this company has gained market share in last 25 years. And China has presence of all global players. The excavator demand in China was up 60% in the month of July. It's up 25% year on year in a COVID environment. And I think this is a company which can be market leader not only in China but on a global front. So while we are playing a theme of short-term fiscal stimulus in China in next 12 to 18 months, but this clearly shows that we are buying a company which can be a global leader in 5 to 10 years time, and hence we own some of these stocks in Chinese industrial space. Moving on to technology, I think technology is clearly going to be a differentiator for emerging markets over next 10 years. The technology companies in emerging markets, and some of the names which I mentioned earlier, they are Alibaba, Tencent on the consumer side. You have Taiwan Semiconductor and Samsung Electronics on the semiconductor or enterprise side. These companies are now one of the best technology companies in the world, and that has completely changed how people look at emerging markets. I think these four companies combined can continue to grow very handsomely, double digit over next 5 to 10 years. We will see continuous technology growth across consumer, whether you talk about e-commerce, whether you talk about social media, whether you talk about electronic payments. And some of these companies are clear market leader, whether you talk about Alibaba in e-commerce or payments, whether you talk about Tencent in social media and payments now. And the companies like Taiwan Semiconductor and Samsung Electronics have actually now become global leaders in sectors like semiconductor, chip manufacturing, and memory. So clearly, we think that technology is core of any emerging market portfolio. We are completely focused on that. I'll give you some of the examples. You see Alibaba being the largest cloud player in China. We think Alibaba is one of the largest e-commerce company. When anybody think about Alibaba, they think about e-commerce, but actually Alibaba is the largest cloud company in China. The cloud investment in China is still 1/5 of what it is in US, and China is now as large as an economy with the size of US. So you can clearly see cloud being a very interesting space apart from e-commerce, apart from payments. And Alibaba as a company can continue to grow across the digital ecosystem. Similarly, Taiwan Semiconductor, I'm sure some of you might know that Intel, who was a global competitor to Taiwan Semiconductor in chip manufacturing, has given up its technology leadership, and actually they have outsourced their manufacturing to Taiwan Semiconductor. Clearly, this company has become a global leader. With a world where technology intensity is increasing, this company will keep on growing faster than anyone else. So when you think about emerging market, I think I want to stress a point that technology has become core of emerging market, which was the case with US and developed market earlier. That's where the fund is focused, and you should clearly see technology driving up as well as emerging markets. The second most important pillar of our fund is consumption. We think that domestic consumption across emerging markets, and especially in places like India and China, going to drive these economies, and domestic consumption across some of these countries is still going to grow very handsomely at high single digit or even faster than that. Again, we understand consumption. I have spent so much time in China to understand consumption, visiting stores, talking to distributors, visiting consumers. We do regular consumer surveys, but we are not playing it as a sector. We want to buy very selective companies that are market leader, which we think can grow very handsomely, double digit over next 5 to 10 years. I'll give you some examples on this sheet. In this COVID environment, we are doing consumer surveys, and consumers are saying we will spend more time on sports and entertainment. We will buy cars because they think about personal mobility. They're still talking about travels in China. Within the 2-3 clear areas where our emerging market fund is invested in China and in consumption is clearly sportswear. I think this is one sector which has shown very strong growth in last 5 to 10 years, driven by both premiumization and increasing penetration. But if you compare the size of the market versus US, and China has 4 times more people, so 4 times more feet, and the size of the economy is similar. China will take over as the size of economy in 5 to 7 years versus US, but the market is one-third at $25 billion versus $75 billion in US. So clearly this is one area which we think will grow from here, and we are exposed to the best companies. So Adidas, which is a company which I'm sure everybody knows here, but it's the largest sportswear company in China. And in global terms, 50% of operating profit of Adidas is contributed by China. We own another company called Anta, which owns the Fila brand in China, and Fila is one of the fastest growing luxury sportswear brand in China. So clearly what we are focusing here is on a sector which is supposed to grow, has been growing very fast, but within that sector, companies which are market leaders and gaining market share. I'll give you another example on automobiles. We own a company called Zhongshan Group. It is the largest luxury auto dealer in China. They sell Mercedes cars and Lexus cars, which are the top 2 selling luxury auto brands in China. And luxury auto market is still growing in China. China is a very large automobile market now, 25 million cars every year, but luxury penetration is still 10%. Expect that luxury penetration in China can grow from 10% to 25%, which is similar to US level in next 10 years. But again, we are not buying Mercedes or for example, BMW to play that theme. We are buying a very specific company, which is first focused on luxury car selling. So it's brand agnostic. They sell 3-4 brands. But apart from that, this is a company which has very clear drivers of growth, not in terms of just selling cars, but in terms of selling services. So what this company does is they capture the whole life cycle of a consumer. Again, a very differentiated business, happens to be in a very strong growth segment, but a very good competitive player which is gaining market share. So technology is a core part of our portfolio, but consumption focused on the right segments, focus on the right brands, and focus on the right companies, again remains a very core and has added a lot of performance to the fund in last 2-3 years. Moving on, when I talked about technology and consumption being core of our portfolio, another large part of emerging markets is financials. Financials is roughly 30% of emerging market index, and there are large banks in all emerging markets, be it China, India, South Africa, Brazil. And we have very cautious view on financials from here. And the reason is very simple. We think that interest rates post the COVID environment have taken a structural decline, and we expect interest rate to be low for longer. And in a low interest rates, most of the financials, large banks, which are average businesses, will find it very hard to operate profitably. So within financials, we are very selective. What we own in the portfolio are the best quality banks in the world. I mean, I can clearly say some of the businesses that we own in emerging market fund are the best emerging market financial companies, or probably the best banks in the world. And the way we think is very simple, and I'll illustrate with this slide. You can clearly see we own large holdings in a couple of Indian banks, which are the largest private sector banks in India. In the Indian financial system, private banks are roughly 30% of assets and liabilities, and the public sector banks are still 60 to 70% of both assets and liabilities. And also you have seen over last 10-20 years that public sector banks have always been more cyclical. They have been less profitable versus private sector banks. So this is a clear phenomenon that private sector banks in any market, and this is the case with India, but I'm sure this is the case with South Africa, or this is the case with other markets, will continue to gain market share. But actually we are not stopping here. I mean, again, this is a theme which any investor can play through private sector banks, but what we are doing is we are further selecting the best private sector banks. HDFC Bank, which is our largest active position in the portfolio, is the best private sector bank in India. It has grown 27% CAGR in last 20 years in its market cap. I mean, from the highs of pre-GFC, the stock has gone up 10 times in last 10 years. And we continue to believe that given their differentiated underwriting, given a strong franchise on the liability side, given a very strong management culture, the company can continue to do well in next 5 to 10 years, similar to what they have done in last 10. Again, we have spent a lot of time with that bank. I mean, I've personally spent at least 5 days within the bank, talking to every business head, talking to branch managers. So all of this conviction comes from very on the ground work which we have done. Clearly, we are cautious on financials, but we own very selected financials which are very high return companies in emerging markets. And lastly, I talked about three large part of the market, which is technology, consumer, as well as financials. I should talk about a bit of differentiated view on commodities. The fund has been largely underweight on materials in last 5 to 10 years. We believe that the world in next 5, 10, 15 years will be driven by technology, will be driven by consumption. So we are averse to owning some of these material businesses, commodity businesses, which are cyclical and low return businesses. But within that, again, we have a differentiated view on a couple of commodities, which I'll explain here. The first commodity which we like is copper, and it is driven by the fact that the demand supply in copper is very tight in both short term and long term. There is a company which we own in the fund called Grupo Mexico. This is a company which has got very good copper mines. They are the lowest cost producer of copper. Copper is largely sale is denominated in US dollar, while a lot of their cost is in local currencies. So here is a company which operates in a commodity which we like in medium term. Here is a company which is the lowest cost producer of that commodity, and which benefits from local cost and US dollar revenues. So again, a very differentiated thought process. While we don't like material as a sector, but we like copper as a commodity, and we are invested there. If you move on to the next slide, this is closer to the home. Gold is clearly one commodity where we have got a positive view. Gold, as I said when I spoke about financials, that we think that interest rates have taken a structural leg down, and we expect interest rate to be lower for longer. We think central bank across world will keep on pumping money as much as it's required, which will keep interest rate low. And all that mean is a very favorable environment for gold. And you have clearly seen this chart on the left hand side that gold has a perfect inverse correlation to interest rates. And in last 3 months, gold has now gone beyond $2,000, and it's in a new zone. So where we have invested in a couple of South African companies, and I'm sure a lot of people on the call knows about them. There's a company called Sibanye Stillwater and Harmony Gold. These companies trades at very attractive valuations on spot gold prices and PGM prices. Sibanye trades at roughly 20% free cash flow yield, and Harmony trades at 12% free cash flow yield, and the stocks have done very well in last 3 months. But again, we think that gold can continue to be a very good commodity to be in, and even if you put a kind of lower long-term prices on gold and some of the other commodities these companies sell, they're still trading at very decent valuations. Again, we can clearly show that we are taking more of a medium long-term view in some of these businesses. Obviously, a lot of it depends on how capital allocation happens across these businesses, but it clearly shows that we have a very focused, concentrated view on a couple of these commodities, and that's where we are invested. So I think what I will stop with this slide, which kind of give you a sum up of what I've spoken over last 25-30 minutes. We clearly think that we are going through an uncertain time, but China has clearly shown us a path that if we can control the pandemic and if governments have the capability to stimulate the economies, the recovery can be very sharp. Second thing, we think the starting point and the backdrop for emerging markets in next 5 to 10 years is very strong. It is pinned on our very positive view on technology and consumption, which has become a very large part of emerging market index. And some of these companies have become world leaders in their areas, and that will drive the index from here. We are cautious on financials, travel, energy, and materials, but we are very selective in some of these areas, and we own some of the best companies in these areas. And lastly, I think in terms of geographies, we continues to be very much interested in China, which is an overweight into the portfolio. India, which is a country which we understand and we believe is the highest growth country in emerging markets. And we are a bit cautious in emerging markets outside Asia. So I will stop here, and I'm very happy to discuss any question that you guys have. Thanks.
Thank you, Amit. That really was a fascinating overview, and you did a great job of taking us around the emerging markets world and actual underlying stocks that you own. So thank you very much for that. I'd now like to hand over to Louis and Rob to ask some questions, and I'm also going to be monitoring questions from our audience.
Great. Thank you, Ant, and thanks, Amit. Well done to you and the team on recent performance. I'm guessing that managing assets during COVID has been challenging, and I thought maybe if you could share a couple of portfolio actions that have happened more recently just during COVID, maybe specific business models that have suddenly become more interesting, or rather some business models that you've been forced to maybe sell out of.
All right, I think a great question, Louis, and I think we have clearly changed some of our views pre-COVID and post-COVID, and I'll explain you a couple of our views. I think I mentioned about financials into the portfolio. Financials was actually a big overweight for us going into the crisis. At the start of the year, financial was one of our largest overweight sector, and our thought process behind financial was that we were owning some of the best return businesses in the world. I mean, I'll give you some example. I spoke about Hdfc Bank. We own a bank in Indonesia called BCA, which is again one of the best financial business you can see across. We own an insurance company in Asia called AIA, listed in Hong Kong, but majorly doing its business in China. And outside Asia, we used to own businesses in Russia. We had a large position in Sberbank. We owned some banks in Latin America. After the COVID crisis, and given where interest rates have gone, our view on financials have become cautious, as I explained. And this is again driven by the fact that interest rates have taken another step leg down, and we think they are going to stay lower. What that means is that some of the businesses which are in very competitive segments and low margin businesses in financials will find it very hard to retain their high ROEs pre-COVID. And we have clearly trimmed our position. I mean, we have been very proactive. Some of those positions were trimmed when markets were coming down in the month of February. We have scaled back our positions in Russia. We have scaled back our positions in Indonesia. We have scaled back our positions in Mexico. But we continue to own some of the large positions in India and the insurance companies which I talked about. So clearly financials from a big overweight has become more neutral and more focused towards very high margin, high profit business. And that's a clear view which we have taken for medium to long term. The second view which I also talked about is our view on technology has become more positive. We were always positive on technology. So Alibaba, Tencent, TSMC going into the crisis was already overweight positions, and we have further increased our positions in some of the areas. And I talked about e-commerce acceleration in China has taken off. China was already the largest penetrated country in terms of e-commerce with roughly 23% e-commerce penetration at the start of the crisis. And while retail sales in China, YTD are still flattish, we have seen 20 to 30% growth in e-commerce businesses in China, which means the penetration has gone from low 20s to high 20s just in 6 months. And we think it is going to stay there. Apart from that, you have seen the Intel example where Intel has given up its chip manufacturing, and TSMC has clearly become a global leader. So we have added to all our leading technology companies. We think the technology intensity of the world, the acceleration has taken over. Whatever we thought would happen in 10 years, probably going to happen in 3 to 4 years, and that's where we are positioned.
Excellent. Amit, can I just ask the question regarding trade wars? Obviously you have a big exposure towards China and you've given the investment case, and I think just what we saw during 2018, how disruptive trade wars were to emerging markets, in particular China. Can you just elaborate a little bit of what you've learned based on what's happened, and also how you're thinking about it going into the US elections now?
All right, I think again a very good question, and I'll give you some context as you spoke about 2018. So the whole trade war started in middle of 2018 when we saw the first round of tariffs from US onto Chinese exports. As a background, I think this trade war is just a symptom of a largest technology conflict between US and China. US and China are now getting to a very similar size economies in the world, very similar global trade share. China was a manufacturing powerhouse and US was a technology powerhouse. But China is trying to challenge US technology leader position. And they did it by all means. I mean, first, they have a very strong domestic market to sell those technologies. So all global companies have to be in China to sell to their domestic market. They were getting a lot of technology transfer from those global companies. But on the other hand, they were also trying to buy a lot of global companies. I mean, they already bought a couple of large automation companies. They will try to buy chip companies, Broadcom in US or Qualcomm in US. And I think US clearly see this as a risk, and that risk kind of manifested in trade war. So I fairly believe that actually technology is at the core of this trade war. Trade is just a symptom, but the conflict is a technology conflict, which is going to stay here. So it's not going away anywhere. I mean, it will go back and forth. You will see some deal, but 6 months down the line, it can again flare up, which is the case right now. So that's our background and basis on that. So how we are positioned in China? Clearly, when 2018 happened, the quarter 4 of 2018 was a very bad time for the fund because we were over-indexed in China. We owned a lot of domestic companies in the Asia market, and the market didn't thought about the fundamental of these businesses. They just knocked down the whole market, and we underperformed. But our clear belief was that we were in very selected businesses, which were more driven by the domestic market, nothing to do with the trade. For example, we own some of the dairy businesses in China, which is all domestic consumption. We own these sportswear companies, which are all domestic consumption. We own a liquor company in China, Kwai Chai Mautai, which is all domestic consumption. So while these companies went down 30, 40, 50% in late 2018, we thought they will come back as market will understand the drivers and fundamentals behind these companies. And luckily that happened in 2019. And the fund had a very good time. We think exactly the same right now. I think this whole trade issues will continue, but we have to be in companies that are either not affected by these trade issues, we think is the domestic consumptions, or companies which actually can benefit from these trade issues. And I'll give you a few examples. We own companies like TSMC, which is the largest foundry or the chip manufacturer of the world. It is based out of Taiwan. It is very important strategically for China as well for as US. And I think there is a tail risk that something bad happens to US and China and we can end up in a war over this company. But this company is so strategic for both the countries that they need the help of this company. So we are not exposed to any businesses which can get impacted by the inability to get technology within China. Within China, we are only invested in domestic consumption stories, which we think will do well irrespective of these trade issues. And outside China, we are invested in businesses like TSMC or Samsung Electronics, which we think are strategic to both China and US.
Amit, and just following on that, outside of China and India, you've touched on Taiwan, South Korea. What are the kind of regions, other emerging market regions, where you are seeing opportunities and the kind of business models that you look to invest in?
So, see, I think we have a very strong research team, and we look at the whole breadth of emerging markets. So I'll give you very few numbers here. We have roughly 50 analysts sitting in Asia, in Shanghai, in Mumbai, Hong Kong, Singapore, which looks at every part of the market, all countries, all sectors, all regions. Apart from that, we have 10 analyst strong team sitting in London, which looks at EMEA and Latin America, and we cover the whole part of the market. So we are actively looking at each and every opportunity everywhere, within, whether it's China or outside Asia. And our portfolio, while we talk about all these themes, are again very focused on bottom-up research and fundamental stock selection. We own few businesses in Brazil. I mean, a business which we own in Brazil is called Localiza, which is the largest car rental company. And obviously, the company hasn't done well in the crisis because of the lockdowns and lower demand. But we think that this company will come out very strongly out of the crisis, as people will actually move towards more personal mobility. So they will need to hire more cars, and this is the most competitive player in the market. So some of the businesses like that, which we think are becoming actually more competitive out of the crisis. I mentioned about the gold companies in South Africa, which we own, which again are positive view on gold prices. We have a large position in Naspers in South Africa, which again is a very specific stock. We like the whole portfolio, but we like their major investment, which is Tencent. We own some very specific businesses in Russia, a small financial business called TCS. So very specific stories outside China, businesses in India, Indonesia. But again, these are not top-down kind of stock selection. These are all fundamental businesses which we like.
Namit, you touched on some of these points throughout your presentation, factors like potentially a weaker dollar, which is supportive of emerging markets, potentially higher growth rates. But why should our investors take investing in emerging markets seriously? And what are some of the other potential tailwinds and opportunities that emerging markets give investors at this point in time, assuming COVID-19 passes?
I think again, I mean, I mentioned about a few themes which are very important for emerging markets, but I think the first basic which is positive, which is in favor of emerging markets and has been always, is the higher real growth. The global real growth, developed market real growth in last 10 years has been around 2%. And we know what happened in Europe. US is probably still a bright spot, but I would, with some certainty, I can say the global growth in next 10 years, the developed market growth probably can be around 2% or less. And with some certainty, I can still say that the real global growth, I mean, so we are taking out the currency impact here in emerging markets, given 40% of emerging market is China now, it is going to become a larger part of emerging markets. 10% of emerging market is India. These two economies can itself take the global emerging market growth to 4 to 5% in real terms over next 10 years. So the basic case is first, this growth differential stays. This growth differential over when we compare a 2% growth versus a 5% growth over 10 years, we are talking about a total cumulative growth of 30-40% versus 70-80%. So it's a big differential compounded over next 10 years. Why markets have not done well in last 10 years, as I explained, is that the constituents of the index was completely different. It was very heavily kind of weighted towards sectors like industrial, materials, utilities, energy, which hasn't done well. But now that index is very homogeneous as a global index. It is more consumption, it is more technology. And lastly, a large part of consumption in last 10-20 years in emerging markets was actually captured by global companies. So you had Google capturing the whole global opportunity. You have Unilever capturing the whole consumption opportunity. You have companies like Nestle capturing the whole consumption opportunity. I think that is also changing. In next 10 years, you have these emerging market leaders like Alibaba, Tencent, Reliance in India, Taiwan Semiconductor, Samsung Electronics, which will capture this consumption as well as technology opportunity. So I think a combination of all these factors, to me, prints a very strong outlook for emerging market versus developed market over next 10 years.
Amit, maybe a last question from me. Technology comes through strongly, obviously, I'm seeing in terms of a strong theme throughout your fund, but maybe just using the example of TikTok right now, for those not familiar, it's a video streaming platform that is owned by a Chinese-based private company, ByteDance. Maybe just using that as an example and the pressure being borne on the business by President Trump to effectively sell its US business to a local US company. Just in terms of that kind of risk to technology companies in China trying to do business in the US, as an example.
So I think technology companies in China are exposed to two global risks. First, the risk, as you mentioned about TikTok. TikTok is a private company. It's called ByteDance. TikTok is a very large short video platform in US, in India, originated in China. India has already banned TikTok as of now. It was the largest user base outside China, and US is in process of banning, or TikTok has to sell to Microsoft, which is being rumored. I think that is an exception. I mean, if you talk about other businesses like in e-commerce, like JD.com or Alibaba or Pinduoduo, which is a new company, most of their business, 90% of it comes from China. There's practically none of their business in US or Europe. Some of their businesses is in now India or ASEAN, in Indonesia, Malaysia. So they're not that exposed to US from a business point of view. So I think TikTok was an exception, Chinese company which went beyond its borders and became a large platform. So obviously it's a risk for any other company going out of China, and I think that risk has gone up. I mean, US-India relationship, US-China relationship has soared, but India-China relationship has also kind of gone backwards. So that risk has increased, but most of the internet businesses or technology businesses in China are exposed to China as a domestic market, which goes into their favor. The second risk is that some of the businesses which we own are listed in US and are invested by the US investor base as well. Alibaba being one of the largest company. And some of that risk has also gone down in last 12 to 18 months. In Hong Kong exchange, you have seen dual listing of some of these companies. Alibaba is now listed both in US and in Hong Kong. So even if in a tail risk scenario, US asked Alibaba to delist in US NASDAQ, they still have a listing which is very much fungible with the US listing in Hong Kong. And a lot of other companies are doing the same. So over the next 6 months, you will see most of the Chinese companies getting dual listing in Hong Kong to reduce some of that risk. As I said in my previous question, that this conflict will continue. So that should be our base case when we invest in emerging markets, that US-China conflict and now incrementally China-India conflict will continue. We have to find businesses which are either less impacted by these conflicts or are just exposed to more domestic consumption.
Excellent. Amit, I also have one final question for you from my side. So you spoke about lower interest rates both in developed and emerging markets for the foreseeable future. What happens to inflation around that? On the one hand, you've got stimulus and you're not moving interest rates. What happens to inflation for emerging markets in the next couple of years, in your view?
So I think inflation will remain benign unless you see growth recovering. This whole stimulus in a lot of places is just to kind of make sure that we don't go into recession. When I talk about China stimulating, they're not trying to accelerate their economy from 4% growth to 8% growth. China is very measured in their stimulus that they don't want a hard landing. So they don't want their growth to go from +4 to -4. What they want is that consumption is growing nicely, and as long as consumption is growing nicely, they will keep the stimulus measured. In current environment, when consumption has taken a hit, they will stimulate to take that growth back to its trend line, but they will not overstimulate. In fact, other emerging markets, as I mentioned, like India or South Africa or Brazil, I don't think governments have capability to stimulate anyways. So we don't think that inflation can be an issue across markets, and that's why these interest rates have room to be lower for longer.
Okay, excellent.
It's a couple of questions from our guests. The one is, how reliable are the numbers that come out of China?
See, I mean, first thing, I think this question has come up always in last 10, 20 years of my investment career. But I say this at the start, and I'll repeat it, that you have to be in China to believe things. I'll tell you a story. I mean, I've gone to China every quarter in last 5 years. I mean, I've spent 1 week every quarter. The last trip was in January. I mean, I was in China till 20th of January, and into the COVID crisis. 3 years back, I happened to be in a hotel, actually 4 years back in Shanghai, which is Grand Hyatt Shanghai. The hotel starts at 58th floor, goes till 85th floor. I was on the 80th floor, and from the window I was looking down. There was a building coming up. It was probably at 20th, 25th floor. The next time I went there, a year later in the same hotel, the building went up to 120th floor. Okay, it's now the tallest building in Asia. So I mean, when we talk about these numbers and huge numbers out of China, whether it's retail sale, whether it's property sales, whether it's financials, you go there and see the size of that country is enormous. I mean, the infrastructure created is enormous. I mean, there are 2 layers ahead of US or Europe. Forget about other emerging markets. So I think when you see there, you tend to believe some of these numbers. That's very important. Second thing is, when we see those big numbers, economic numbers, we take them as a trend or just a guide to our investment thought process. We go back to our main driver of our investment process, always the fundamentals of companies. And some of these companies have very high standard of corporate governance. You clearly see the products that they sell. So again, go back to the basics. Go see these things yourself, and then you will have trust in numbers. So while some of the numbers can be here and there, but I would generally believe that on a totality basis, these numbers are reliable.
Thank you. Another question. Clearly a very big opportunity in emerging markets, but why would someone go active versus passive?
So again, I mean, I think while emerging markets have not done well versus developed market in last 10 years, one area which has done well is active management versus passive management in EM versus DM. I mean, I was seeing a chart today that active management has done very poorly in developed market in last 5-10 years, because a large part of your index growth was driven by some of these large companies, and the market breadth has been very narrow. So it's just you invest in passive instruments, and they in turn invest in Apple, Google, Amazon, Microsoft, and you get that growth. Okay. While some of the technology companies that I talked about have become large in emerging markets as well, I think emerging markets still remain a very fragmented market. I mean, the consumption area I talked about in China, the financials I talked about in India or Indonesia, even the technology companies, it's a very fragmented and broad market. And when the market is fragmented and broad, active management will always do well, because that's when you have to go and research the companies, find market leaders, find differentiators, and these companies I think can easily double, triple versus market over long term. So I think that's where I do believe, I don't know about 20, 30 years, but next 5, 10 years, there is still a big scope for active management in emerging markets, which we have clearly seen in last 5, 10 years as well.
All right, perfect. Amit, thank you very much. And thank you also to all of our guests that joined us today. I think, unfortunately, we do have to end it here. It's been pretty much smack bang on an hour. But I do look forward to seeing everyone again on our future Meet the Manager webinars. And as you can see, we do try to bring the world's leading asset managers to the table to try and make sense of the current and future financial markets. If anyone listening would like a one-on-one to discuss your personal investment portfolios, please reach out to me via this webinar or via my LinkedIn profile or via Carrick's website at www.carrick-wealth.com. Thank you all, and please stay safe.
Thank you.
Thanks. Stay
Thanks,
safe.
everyone.
Bye.
Yeah, bye-bye.